David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, clients and friends. Thank you for joining our podcast today. Please accept my apologies for the length of time between these updates. Clearly, the year has gotten off to a frenetic start, and we continue to have review meetings on an accelerated basis with all of you who are advisory clients. This podcast will be somewhat lengthy, but I promise that it is packed with the most up-to-date economic information that is having a direct impact on my advice to you and the exposure that we have to economic sectors and general securities positions that we hold. Let me preface this podcast by simply stating that at a high level, I do not like the pattern that I see materializing as it pertains to economic data. Some may argue that what you're about to see could merely be a bump in the road, and I admit this could be plausible. It becomes increasingly disconcerting, however, when you see multiple economic metrics painting the same picture and begin to see confirmation from both equity and bond markets that this could be the beginning of a new downward trend. If you'll recall, prior to the election, for those of you who are advisory clients, we constructed options collars. We purchased put options, or at the very least, we adopted stop-loss strategies in an effort to span the period of time between October and the point at which we could determine clarity with regard to the election results. Now, on my side of the desk, we played many what-if games with possible electoral outcomes. What do we believe might happen if President Trump wins re-election or if Joe Biden defeats him? What happens if we had gridlock in Congress or not? At the beginning of the year, I had 4 sets of different models ready to execute based on the answers to those questions. I have covered this with all of you many times over the last 6 months. To reiterate, we try to be proactive at everything that we do. My assumption was that if we had an administrative change with no gridlock in Washington, that such might be detrimental to the growth cycle within which we found ourselves previously. Over time, I thought this could result in declining economic metrics and eventually manifest in market volatility. I believe that we are seeing exactly that unfolding today. What I want to do in this podcast is briefly touch on a number of economic metrics and then draw reference to the allocation of models that we use to govern not only the advisory client accounts, but also portfolios within packaged products like variable life and variable annuity products. I believe that what we can observe today is the beginning of a validation process of the proactive stance that we adopted back in early January as we made significant changes to the investment models. So let's begin our conversation with gasoline. By now, I'm sure that you have all observed the increase in the price of this economically inelastic commodity. I say economically inelastic because you must drive to work. If you have children, then you take them to school, you make frequent trips to the grocery store, and so forth. Gasoline is a commodity that you will consume in relatively the same quantity because there is no other choice. Therefore, if the cost of that commodity rises, then you have fewer dollars left with which to consume other things. In this example, the rising cost of gasoline acts as a tax. And it's a regressive tax because we are all dependent on gasoline regardless of your wealth status. Even if you don't drive a car, if you consume food, wear clothes, take prescriptions, or have anything shipped to you that you might purchase online, then fuel was involved in delivering those items. We are beginning to see higher cost of consumables that reflect the higher cost of gasoline. Please observe this graphic from the St. Louis Reserve branch of the Federal Reserve Bank. As you can clearly see, at the time of the election, the national average for a gallon of gasoline was $2.10. Today, it's $2.86, And in my opinion, this trend is neither slowing down nor will it anytime soon. Why might that be the case? Well, in this graphic, you're observing the latest rig count for North America oil production as reported by Baker Hughes. Currently, we have 430 rigs producing in North America. That is down by 234 rigs from this point last year. Relative to previous production levels, we have scarcity in terms of the U.S. domestic oil supply. Now, this is happening at a time when the new administration has made its stance known as it pertains to fossil fuels. Much like the previous Obama administration, I believe that we can anticipate that the Biden administration will also not be friendly to fossil fuels. We can cross-check this with the current data from the Cushing, Oklahoma transfer facility. Now, this is the largest transfer facility in the United States. Currently, it is at 57% of its capacity. Now, just over 1 year ago, the facility was at 100% capacity. Therefore, I believe that we can safely observe scarcity in the supply of U.S. domestic oil production. Anytime a commodity becomes increasingly scarce, this supports the prevailing market price of that commodity. Now, on this graphic, you are observing the current M2 money supply. And as depicted over the previous year, the increase in the supply over the previous year. And again, this comes from the Federal Reserve Bank of St. Louis. 1 month ago, Chairman Powell indicated to the House of Representatives that a 23% increase in the M2 money supply did not bother him. Now, those were his words. In my opinion, this should have been enough for members of Congress to demand his resignation. The Federal Reserve has a dual mandate, one of those mandates being the control of inflation. A 23% surge in the M2 money supply should cause great concern with regard to controlling future inflation. On this graphic, you can see the historical rise in the money supply going back to 1957. Please observe the gray bar around the year 2008. This was the Great Recession. On the 15th of September 2008, Lehman Brothers failed. Between the 15th of September and the 15th of October in 2008, the Federal Reserve Board promulgated 10 new spending facilities. Do you remember TARP? We were bailing out banks and extending FDIC insurance to levels of $250,000 that covered non-bank money market accounts. The Federal Reserve printed a ton of money at that time as well. See that little blip around 2008? That was the increase in the M2 money supply at that time. Now observe the far right of the graphic. Do you see the surge in the money supply over just the last year? It is without historical precedent. Our Federal Reserve Chairman said 1 month ago that this did not bother him. The classic definition of inflation is too many dollars chasing too few goods. Ladies and gentlemen, I give you too many dollars on this graphic. Keep that point in mind for future reference. Back to gasoline. Gasoline is a distillate that is refined from oil, obviously. Oil is denominated in dollars. The more dollars that we print, the weaker the existing dollars become. A commodity that is denominated in dollars will go up in price if the currency that denominates the commodity becomes weaker. So do you see the double whammy here? We have scarcity in terms of U.S. domestic supply, which makes us increasingly dependent on foreign sources of oil. So blend in a Middle Eastern fear premium here as well. Furthermore, we have an increasingly weaker dollar. As the money supply increases with impunity, and we have the Federal Reserve Chairman's feigned oblivion to the importance of this observation. None of this seems to be slowing down, and we haven't even gotten to peak driving season yet. I do believe that the consumption of leisure will be a strong investment theme this year as we continue to emerge from COVID. Herd immunity grows through increasingly greater vaccination and for other reasons. Therefore, I do believe that the demand for gasoline will be higher over the coming months as people travel and see family that they haven't seen in over a year and go on vacation after a year of COVID-induced stress. This is the season when we normally begin blending that gasoline with ethanol, and it always creates a bottleneck in the refining capacity. So let's bring this all together. We have scarcity of oil, we have a weakening dollar that denominates the price of that oil, and the likelihood of stronger demand for gasoline as we get into the driving season of the summer. Gasoline has already moved from $2.10 a gallon to $2.86 a gallon, and in my opinion, at this pace, we may observe $4 or higher per gallon of gasoline by the end of the summer. This acts as a tax, leaving you with increasingly fewer dollars with which to consume other things. 70% of gross domestic product is your individual consumerism. From this one observation, I do not believe that this bodes well for future economic expansion. So now let's move on to other economic observations. We have already discussed the Fed's penchant for printing money. We have a Treasury Secretary who she herself once was a Federal Reserve chairperson, who seems to be very much in favor of the next stimulus plan. We have already passed a $1.9 trillion COVID stimulus package. We are promulgating a $2.31 trillion infrastructure bill, and as we speak, the groundwork is being laid for what could potentially be a seventh round of COVID relief in excess of $2 trillion. That money will have to come from somewhere, and the Federal Reserve Board has indicated its willingness to print as much money as needed to fund these measures. Furthermore, we seem to have a Congress that is willing to rubber stamp anything in the name of stimulus that comes across its desk. The dollar is weaker than it was prior to the election, and it continues to weaken. That is another way to suggest that inflation is rising. What can we observe in terms of inflation? Remember, this is the rate by which your ability to consume is declining. What you are looking at now is a graphic from Brian Westbury, chief economist at First Trust, that depicts the rise of inflation at the producer level. The cost of materials, the cost of employment, the cost of shipping, and other factors that go into the creation of the product that you purchase is rising. Indeed, we have 5 consecutive months of sharply rising inflation at the producer level. Can you see the nearly vertical line on this graph? If you annualize the result that we have seen over the last 5 months, we are tracking at 12% inflation on the producer level. Yes, some of this is a rebound from economic deceleration that was due to COVID, so no, I don't believe that we will actually see 12% inflation over the course of the year, but bear in mind that the target for inflation at the Federal Reserve level is only 2%. We are tracking multiple times over that target right now, and our Federal Reserve Chairman has expressly stated that this does not bother him. That bothers me. Even if we wind up with half of this, and your result is 6% inflation, that would still be 300% above the Federal Reserve target for inflation. This is not a good thing. Now you are looking at a graphic of the Consumer Price Index. Again, inflation at the producer level does not stay with the producers. In virtually every case, this is passed along to the consumer in the form of higher prices. The slope of the increased line here is also sharply positive. If you take the last 5 months worth of data and annualize the result, it is suggesting that inflation at the consumer level is tracking at 9.6%. Again, we probably won't see a number quite that high, but if it results in a 5% cost of living increase, that too will be multiple times over the target of the Federal Reserve. So gasoline is significantly higher. It acts as a tax on your ability to consume, and that's not showing any signs of deceleration. Meanwhile, we see inflation readily evident at the producer and the consumer price level. My question is, can we now begin to measure a response in the behavior of consumers? You're looking at a graphic that depicts housing starts. We have 3 consecutive months of decline in housing starts. Now that's odd, Because as of today, you can still obtain a 30-year mortgage for just over 3%. That is historically low. Why then might we be observing a sharp decline in the construction of new homes? Maybe it's because consumers are increasingly unwilling to purchase a plot of land at a very high price relative to previous years, upon which to build a home while building materials are near all-time record high prices and with labor that is very hard to find, while they are beginning to experience price increases on the economically inelastic commodities such as gasoline, and inflation is beginning to become evident in many other areas. We can cross-check this with the graphic that you're looking at now, which depicts existing home sales. Again, following a very strong period of time post-COVID, we have this 3-month period that seems to be forming a lurching over point. The question is, might this simply be a bump in the road or the beginning of a downward trend? I would suggest to you that if the disposition of Washington were different, even if we just had gridlock, I might be inclined to view this as a bump in the road. However, given everything that we've discussed already, and the fact that many other economic metrics seem to be showing similar trends, I am growing increasingly worried that this is the beginning of a new downward trend. What about new orders for durable goods? Okay, well now you're looking at a graphic that depicts this historical activity. Clearly, we had a sharp resurgence from the COVID-induced lows of last year, and now we have this curious lurching over point from last month. Now, this graphic depicts the consumption of cars, boats, refrigerators, dishwashers, and other big-ticket durable items. Again, I'm afraid that this is beginning to show the reluctance of consumers to extend themselves with big-ticket purchases, given everything else that we can observe at this point. Might this have something to do with declining personal income? Well, now you're looking at a graphic that shows personal income declining by 7.1% in February, and the first reaction is to suggest that this simply reflects the absence of COVID stimulus checks that were received in January. I beg to differ. The people who received those checks earned $75,000 or less. One $1,400 check on an annualized $75,000 of income does not constitute a 7.1% decline in total income. There are other factors having an impact on personal income. So let's just pause and reflect on what we've covered. We have an expanding M2 money supply. Therefore, we have dollar weakness. This is resulting in rising prices for economically inelastic commodities such as gasoline, which is acting as a tax. We have rising inflation at both the producer and the consumer level, and we are beginning to see that manifest in such things as consumer behavior related to housing starts, existing home sales, and orders for new durable goods, possibly as a function of a decline in personal income. Now let's observe recent trends in retail sales. Now, this reflects our consumer behavior as you and I go to Walmart to purchase various and sundry things. This was also down in February by 3% after a robust recovery over the previous 12 months. Yes, we did have a snapback in that number on Thursday, the 15th. But the overall trend seems to at least be decelerating, and this point in February seems to coincide with all of these other curious potential lurching over points that we've just discussed. Now you are looking at a graphic that you've seen many times before. I've used this graphic in many other podcasts and Zoom meetings. This depicts the economic cycle. Again, I did not create this graphic. Indeed, I saw this for the first time 25 years ago and just committed it to memory because it's beautiful. At a very high level, I've encouraged all of you to consider this in terms of seasonal weather patterns. On the far left of the graphic, consider this springtime. Spring gives way to summer, which gives way to fall, which gives way to winter, and then we're back into spring on the far right side of the graphic. Consider how your behavior is incentivized as the seasons change. We start with long sleeves, move to short sleeves, back to long sleeves, then to jackets, then back to long sleeves. I suppose you could wear short sleeves in January, but it probably wouldn't be very pleasant. Your behavior is incentivized by what you feel, in other words, and the same holds true for economic cycles. Your patterns of consumption are incentivized by such things as your income, the rise or decline in that income, your confidence, inflation, and many other factors. As of 6 months ago, I was convinced that we were still with the growth phase of the economic cycle intact. Among other characteristics, we had rising wages, higher velocity of money, a rising consumer confidence. Therefore, such things as investments in consumer discretionary areas, industrials, technologies, and other things outperformed the other areas of the market. While we had those characteristics intact, my suggestion to you today is that we are now in the beginning of the deceleration phase of the economic cycle. I believe that the market is telegraphing this because some of the strongest performing sectors in the market today are financials, consumer staples, and utilities. These would not be areas of the market within which you would expect to find strength if we were indeed still in the growth phase of the economic cycle. Now let's take a look at what the bond market is suggesting to us. You are looking at a graphic of the TED spread. Again, this is simply the difference between the 10-year Treasury yield and the 1-month LIBOR. At a very high level, the lower the TED spread, the more the bond market is suggesting to you that stronger economic conditions are ahead. The higher the TED spread, the more the bond market is telling you that it perceives weakening economic conditions ahead. As of the date of the election, the TED spread stood at 10 basis points. Today it stands at 17 basis points, and within the last week it has recently been as high as 19 basis points. Yes, 19 basis points is still a very low historical TED spread. Nonetheless, it is nearly double that which we observed just 5 months ago. To me, this is the bond market suggesting that economic conditions are worsening. Let's cross-check that with what we can observe from the Treasury yield itself. On the far left side of the graphic, we see the reaction in the bond market from the Federal Reserve's previous actions to fund the CARES Act by ballooning its balance sheet. That resulted in a historically low yield for the 10-year Treasury. That yield remained fairly constant until the election. Curiously, we have seen the 10-year Treasury yield rise by 100 basis points since the election. This is odd because the Federal Reserve continues to purchase $60 billion of Treasury securities per month in its efforts to fund various and sundry bills that continue to pass through Congress. Remember, there's an inverse relationship between price and yield. As prices rise, yields drop, and vice versa. If the Federal Reserve is purchasing $60 billion of Treasury debt per month, then I would imagine that such buying support would result in higher prices and lower yields. We have the opposite. Why are yields rising so sharply while the Fed is buying so aggressively? To answer that question, consider this. Back in November, the proposition was, lend the government money. It will be redeemed in 10 years. And along the way, you'll be paid 79 taxable basis points for the privilege of lending money to the government. The first threat now is that the strong dollars that you use to purchase the Treasury will be redeemed with weak dollars 10 years from now. The second threat is that 79 taxable basis points will not be enough to leave you in a net positive real return disposition 10 years from now. Remember, 79/10% is the rate by which your ability to consume will increase over those 10 years. We have already observed inflation metrics that are tracking significantly higher than that. So if your ability to consume is ostensibly declining by 5% per year, while your ability to consume is increasing by 79/10% per year on a taxable basis, then in my opinion, this is a 100% guaranteed chance of loss as it pertains to purchasing power, which is the most important characteristic about money. It's what you can buy with it. It's not the physical preservation of it. Therefore, it is no wonder, in my opinion, that what we're seeing now is such significant selling pressure in the Treasury complex and this is not a positive sign for future economic growth. Now you are observing the Morningstar Market Barometer. You're looking at the previous full year for 2020. Now, as I prefaced in our comments earlier in January, I encouraged everyone to adopt a model that was significantly more defensive and much more heavily laden in value securities rather than growth securities because of what I thought might be ahead of us economically. Last year, according to this graphic, the market itself was up just over 20%. The growth discipline, however, was up over 44%. Notice value to the far left side of the style box. That was down by negative 1.31%. Clearly, the energy that fueled the market's recovery last year came entirely from the growth side of the market. Growth performs well when you have higher velocity of money, higher consumerism, which is a function of rising income and rising spending power. The economic metrics that I have covered so far indicate a declining ability to consume with higher inflation, and we begin to see evidence of slow velocity of money, and we haven't even discussed the potential for rising taxes in 2022. Already, as of the end of the first quarter, we can see year to date that the growth side of the market, which was so strong last year, is negative across the board. Look at the far left graphic in this style box that depicts the market's returns as of the end of the first quarter. Can you see the strength in the value discipline? Value is up about 12.5% as of the end of March, while the broader market itself was higher by about 6%. To me, this confirms that the market is in the middle of a sector rotation that is being prompted by everything that we have discussed so far and that we anticipated back at the beginning of the year. The bond market seems to be confirming that as well, with metrics such as the TED spread and the 10-year Treasury yield. Now, let me pause here while I have cited data from Morningstar. Let me add this brief disclosure. Past performance does not guarantee future results. Indexes are unmanaged and cannot be invested into directly. So in conclusion, I do not like the pattern that I am seeing developing across a myriad of economic metrics. And at the same time, I am pleased that we made the decisions to become significantly defensive across all of the models that are governing your advisory accounts. By sharing this information with you, am I suggesting that the market itself might be down this year? No. Remember, there are 11 sectors in the market. And last year, the strength was fueled entirely by only 5 of those sectors. This year, I believe it will be the other 6 sectors, which are more value and discipline, that will lead the market to potentially higher levels. You have to look more deeply than just the headline market number. We have to understand what sectors of the economy represent the greatest concentration in our portfolios. We are proactively monitoring these metrics every month. We are making tweaks to those models as we deem it to be appropriate and necessary. At the end of every quarter, we conduct a model assessment and continue to make those adjustments as necessary. So we will continue to remain in an accelerated meeting loop schedule with all of you until this volatility declines to a greater extent. Between then and now, please forward your questions or needs of clarity to me, and know that I am monitoring these and other metrics on a daily and weekly basis, and will continue to be mindful of how these things might impact our overarching investment strategies. Thank you for your attention to this podcast.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.